Welcome to Markets Now. I'm Michelle Rook along with Chip Nellinger, Blue Reef Agri-Marketing. So a mostly higher day in grains, cattle futures to the plus side with some more new contract highs. We'll talk about that in a moment with hog futures setting back. So the grains, let's start off there, Chip. And we are seeing what, a recovery rally, or was this rally all about weather?
Well, I think at the heart of it, it's all about weather. You did kind of combine this uncertain weather forecast right at the end of the month and the start of a new month. So that adds to some, fund buying and selling. And I think they're at the heart of it, getting out of some shorts. They've made great money being short corn, beans, and wheat here for the last couple of months. And I think this uncertain forecast going out into the middle of the month of June, really dry weather, especially in the Eastern Corn Belt, really has people on edge. So we'll see. At the heart of it, it's a fight between just horrendous demand in the short run versus the real acute need for rain soon in the next week to two, or we're going to start going backwards on yields, and the funds would have a lot more shorts to come out of and buy. So full-fledged weather market. These weather models are flip-flopping on a daily basis as they typically do, and there's a high amount of uncertainty. Volatility is increasing, and it's going to get to be a bumpy ride here the next few weeks based on the weather.
The Drought Monitor out this morning, though, did show an intensification or at least an expansion of some of the dryness in the central and eastern Corn Belt. It seemed like the market kind of took off after that. And so we're going to be watching that closely, aren't we?
Yeah, absolutely. And in fact, I saw that. I think what you're referencing is actually at this point in time, there's a higher percentage of the Corn Belt that are in drought conditions than there were a year ago. And we know there were some obvious dry weather concerns and nipped the top end off of yields last year. Now, part of the Western Corn Belt have received some decent rains. There's been some small pockets of scattered rains in the Eastern Corn Belt, but by and large, we're up in the low to mid 90s now. The heat stress is building. And I think compared to a couple of years ago, we've got this corn crop at a less mature stage. So it might be susceptible to some more yield damage, but it's all about the weather and the rainfall the next 2 weeks. We're really going to need to see some better rainfall patterns develop into the mid to late June, or we're really going to have to start working backwards on our yield assumptions.
Right. So if we get the rain, the market is vulnerable. If we don't get the rain, how much of a rally could we see just because the funds have gotten so short in so much of the grain market right now?
Yeah, they really have. If you just look at a chart, forget about the calendar, forget about drought and weather for a minute. Really, from the low 550s up into the mid 560s versus December corn futures are going to be really hard to get through on the first push. So I'm not saying that you can't eventually get through there. Obviously, if we don't have much rain in June, and this is going to extend into July, the first half of July on hot, dry weather, then all bets are off, and we're going to be up closer to $6. But on the first push here, 550 to 565 is going to offer some much tougher resistance to get through. It might take a little while, and the forecast continuing to be hot and dry into mid to late June to get much north of 565.
What about beans? Because we had some chart damage done with the fund selling that we saw the first 2 days of this trading week.
Yeah, new moves, into new lows the
Into new
other
lows.
day on beans. We recovered today. Beans are kind of the last market out of corn, beans, and wheat to have the funds exit their longs and get short. So I think it's more on the fence there. Obviously, they're sitting back saying, hey, the bean market, the bean production can kind of sit out here in the field. They get through some dry weather in June. As long as some better rains come in July and August, we can still have okay bean yields. I don't know whether that's a correct assumption or not, but the bean market seems to be, a little bit of a laggard in here. And I think it all depends about the corn and weather into June. If corn continues higher, I think it's going to drag beans along with it and force some of these recent shorts out of beans and maybe give us a better rally. If the rains come, beans might have more downside because they were the last one to fall, and the funds would have more capacity to short the bean market relative to their current position in corn and wheat. So I think beans are at a volatile level here. They could accelerate dramatically one way or the other, but it probably lands in the hands of the corn market in the direction of this weather pattern that we see into mid-June.
So then does wheat have to follow corn and soybeans too?
Well, wheat plays in there as well, right? And it's just been pummeled. I think that's part of what's held corn back. You talk about, the front month of Chicago wheat getting, equal to or under where corn was. And so that doesn't happen very often. Wheat certainly is part of that. Some of the rains that we've seen in the plains is a good excuse for the funds to continue to sell the wheat market. But I'm not so sure these rains really did anything beneficial. I think it's too little too late. If anything, maybe it damaged it because in some areas the rainfall was too heavy. But I think it's going to take the combines rolling and getting some firsthand yield data, out of the combine seat to get a better feel. I would think there's some upside. The funds have a massive short in wheat. If corn keeps going based on deteriorating weather in June, I think wheat and beans to a lesser extent will follow along with it, and you'll see some short covering. But right now, boy, the funds just seem like they want to sell every rally in wheat, and it's paid them for the better part of 3 months now.
Yeah, unfortunately, it has. Okay. Cattle taken off, hot market right now, new contract highs in the front month and live cattle for, I believe, the 6th day in a row. But some cash trade is pushing it. And I'm going to quote these, and they may change, obviously. But right now we've got cash in the south, 175 to 178 in the north, 183 up to 185, 291 to 292. Wow, that market's on fire.
It is on fire. That is right. It's pushing the cattle futures sharply higher, obviously getting a little bit, not quite blow off top, but we're sure getting it extended to the top side here. Can it keep going? Absolutely. Before today, you saw that, June futures were $12-ish below where the northern cash trade has been. So that's what we're getting into. It's different from 3 months ago where we saw the futures have a premium to where cash is. Now it's the opposite. Cash continues to move higher, boxes move higher, and that's driving us. But eventually, the funds are going to have their fill of the long position that they've got. They continue to add to it. It's paying them. But like any market, they're eventually going to want to take their money off the table. And you have to really watch for these high price levels to start ratcheting demand back. So I'm still friendly in the short run. We've got some upside left. Maybe we can push this up into the low 180s, maybe 190. But I think we really have to be cautious, especially if we continue at this sharp of an angle to the upside.
Not only do you have maybe vulnerability from the funds being so long, but at those levels, don't you get some hedge pressure up there too?
Well, eventually, I think
Yeah.
that, maybe that's some of what's been driving this most recent push is some hedge liquidation, right?
Right.
As people get bulled up and exit some of the initial short hedges that they had. So I think there's a lot at work here, kind of running the gears, and I do think that you do have to watch out for that. Eventually, we'll get to a level that becomes profitable, even with these higher price feeders. You're going to have some increased hedge pressure, and you might at the same time have the funds want to start taking profits. Now, there's nothing that triggers them out of it just yet. I don't know that there's a actual number or line in the sand that says, hey, the funds are done. Usually they let the peak come and then they sell somewhere off of the highs. So the high hasn't yet come, most likely, given the action of today. But you do have to be a little bit cautious here eventually that the funds are going to say, hey, it's been fun ride being long. I'm going to get out. I'm going to take my money. And at the same time, if that happens to coincide with weakening demand, it can be an ugly situation.
Yeah. And let's hope we don't have any black swan event to get them out the door all at the same time. Okay. Hog market. We had a big reversal the other day, limit up move on Tuesday, some nice follow through yesterday. It looked like a V bottom. Do you think we are bottoming?
Well, I hope so. You don't find often in history a market that was as far oversold as what we've recently seen in hogs.
Yeah.
End of the month drove a little bit of short covering, I think, from the funds, evening up some positions, taking some profit. They held a record short position there in the hog market. You saw cash explode a little bit higher. Was that the futures driving the cash or vice versa? Bottom line, you've got a V bottom that's pretty classic in a livestock market, hogs and cattle. You've got an island bottom currently. And so if we can gather ourselves here, even though we're a little bit lower in the deferreds today and rally, you've got more fuel to blow some more shorts out and push this thing higher. About the exact opposite of what is happening in the cattle market. We've got the nearby at a premium to what the August contract is. Sitting here at the first day of June, I don't know that I ever remember that happening where the deferreds, the summer months, are below where the lean index and the June contract is. So it's a very weird situation we've got going. If the cash can stabilize and rally a little bit. I think there's plenty of room for the July and August contract to rally, but right now they're a little bit reluctant.
Yeah, and let's hope we have some pork producers left by the time this cycle is done to buy back in here when things get better.
It's just a brutal situation out there for the hog producer currently.
No doubt. All right. Thanks so much for joining us, Chip Nellinger, Blue Reef Agri-Marketing. That's Markets Now.